Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azuz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the June investment edition of the Wealthy Behavior Podcast, where I talk to Heritage Financial's Chief Investment Officer, Bob Weiss, about what's going on in the markets and investment universe you need to know right now. Bob, how's it going?
It's going well. We've had a nice recovery from the lows in April, and markets are looking pretty good on a year-to-date basis.
So you wanted to run through, like we typically do, how different indices have performed to maybe get that out of the way, and then I think we have a few topics we wanted to dive deeper into.
Sure, I'll just run through year-to-date numbers. MSCI USA, so US total stock market, up 2% year-to-date. MSCI World ex USA, so this is developed international equity, up 16.5% year-to-date. And MSCI Emerging Markets, that's up about 8.9% year-to-date. And then looking at the bond market, the Bloomberg US Aggregate Index is up about 2.2% year-to-date. So stocks are up, bonds are up, foreign's leading US within equities, but overall, it's looking like a pretty good year, despite all the volatility that we've had.
We've talked about indices before. I don't know that we've talked about the MSCI US index. Why do you use that instead of maybe what people would look at more frequently, like the S&P or the Russell 3 or something like that?
Yeah, when you step back, we use the MSCI ACWI, MSCI ACWI All Country World Index, which is about the largest 3,000 companies in the world. And it's market weight. There's no inclusion exclusion criteria like S&P uses. S&P, you have to be profitable, for example. MSCI takes about the largest 3,000 companies in the world, and that's your pulse on the global market. And then they break that into three regional segments. MSCI USA is the US portion of the ACWI. The World ex-US is the developed non-US portion of the ACWI, and the emerging markets is the emerging markets portion of the ACWI. So those three indices I read off relating to equity all roll up collectively to make the MSCI ACWI, which is the industry standard pulse of the global stock market.
That's great overview, Bob. Should it differ materially from the S&P 500 for our
The
listeners?
MSCI USA is very similar to the
Very
S&P
similar.
500.
Okay, great. So that leads you, what you were talking about leads you to something you wanted to discuss, which is, and I'm paraphrasing and you'll do a better job, but basically markets have recovered from April. And so if you felt like you had wanted to make changes, given how expensive the US was, you started to see the benefits of diversifying, but you were worried you missed out on an opportunity. I think you wanted to tell people that these opportunities are longer than they last, but also there's been a little bit of a reset, and you have the chance right now to kind of retool your portfolio.
Yeah, in my role, I'm fortunate to get to meet a lot of end investors, potential new clients, people who are maybe doing it themselves, and you hear the psychology of investing, why people are currently positioned. And if you rewind the tape and go back 5 months, a lot of investors were heavy in US equities, and we would say, well, you should be more diversified, you should have more bonds, you should have more international, and say, I hear you, I think that's probably the right thing to do, but it's working really well, so I'm not sure I want to make a change. And then April happened, and they're probably thinking, wow, I wish I took some of the chips off the table on the US stock market after it went down about 20%. And if I reached out to them then, which I don't do, I don't chase after people. But if I did, they'd probably say, yeah, I wished I listened to you, but it's too late now. Now that stocks are down 20%, it's too late to diversify. But now we've had a recovery. So, that cohort of people who are heavy US, over their skis on risk, not globally diversified, early in the year, it was just, well, this is working. Why change? Then it didn't work, and it didn't work fast. And it was, oh, I missed the chance to diversify. But now we've had a recovery. So, now my perspective is, look, you have a second chance here. Valuations in the US remain high, risks remain At this point, while international has done well year to date, it can outperform the US for a decade, just like the opposites happen how the US outperforms international for a decade. Historically, that's what you see, these very long runs. So you didn't miss it at all. I think it's definitely a good time to diversify the portfolio, get your risk level right, get meaningful foreign equity exposure in the portfolio. So those are just some things that you don't always get a second chance in life and or in investing. Um, and here's a case where you saw the blip and probably had some, oh, I wish I did something differently. Then it recovers, and it's easy to be complacent, but you really should get appropriately positioned.
So we're not giving personalized asset allocation advice, obviously, on this podcast, but give people a sense of what does a global stock portfolio look like within reason, within certain bands? Like what type of international diversification are you talking about and where?
Yeah, so back to where we started, the MSCI ACWI. If you just had an unlimited checkbook and bought the largest 3,000 public companies in the world, or I don't care where they are, I'm just going to buy the entire company and then see what my portfolio looks like. It's around 65% US, 35% overseas. And we think that's a reasonable starting point. Anything different from that is an active decision to overweight or underweight a specific country. So roughly two-thirds US, one-third overseas. So it's not, I wouldn't call that extreme. It's still a majority in the US, but a meaningful allocation, like I said, to foreign equities. What's interesting, if you, there are studies that do this where they go around the world and look at people's portfolios, and the average investor, regardless of where they live, has a portfolio that's about 80-20, 80 domestic, 20 foreign. And that could be a US investor who has 80% in US stocks and 20% spread around the rest of the world. That could be a Canadian investor who has 80% in Canadian companies, 20% around the world. And you get the point. You go to France and it's 80% in French equities and 20% in what they consider foreign. And individually, everyone, stands by the home country. It's called a home country bias, and I think it makes sense. And I'll sprinkle a little overseas, but collectively, it works out to about 65 US, 35% overseas, and we think that's a rational starting point.
Yeah, I think for people who are interested in diving into it a little bit further, on February 20th, we had Jeff Kleintop, Charles Schwab, Chief Global Investment Strategist, who has been educating investors on international diversification for a long, long time. And his line is when he's asked that question, he always says, just probably more than what you're already doing in terms of international exposure. But that's a good episode if you want to check it out and dive deeper. So, going from there, jumping a little bit to maybe something that's going on might be on people's minds. A little bit of a preamble to this. I just got back from a 2-day meeting with a bunch of other RIA presidents, CEOs. It's a group that we've been meeting for 5 or 6 years, become really close friends, and just collaborating on best practices, learning from each other, helping each other out, and before dinner, you're having a cocktail after a hard day of work, and the deficit came up. I know we're very interesting people. We talk about the deficit before dinner after work, and I think there was just a level of concern bandied about related to it that I don't think it was just us. I think you're hearing more and more investors nervous about the bond market, nervous about this bill that doesn't reduce deficits. Jamie Dimon's talking about you're going to see a break in the bond market. Ray Dalio is always predicting the end of something. That's probably too dismissive. But I know that you have thoughts on the deficit, but we're not getting into our political, desires. We're more talking about how it could impact the bond market, what we're seeing in the bond market, and what we might like to see to have a little bit more confidence, I guess, long term in the U.S. bond market.
Yeah, it's becoming more of a topic these days, and I don't think it's necessarily a partisan topic because the situation the U.S. is in now is a product of political actions made by both parties over a long period of time. So it's not taking a shot at any one individual or party in particular. But just to start with some data, if you go back just to 2015, so not that long ago, federal spending was $3.7 trillion. Tax receipts or federal revenue was 3.25. So the deficit was about 0.45 trillion, 450 billion. So big number, $450 billion was the deficit. And the public net interest expense, so the interest the government paid on federal debt was 220 billion. So if you take that 220 billion that they paid in interest at the time and divide it by revenue to the government, it was 6.8%. So a
Mhm.
way of thinking of it, if you're doing like a household budget, you make $100,000 and say you spend $100,000, well, $6,800 a year goes towards debt service, interest expense, which it's meaningful, but 6.8%, it's still a smallish number. You fast forward to this year, that 6.8 number is 21.4% in 2025. So just in the stretch of 10 years, it's now 21.4% of the of government revenue. And looking at the top line numbers, total expenses are close to 7 trillion, I think 6.97 trillion, and inflows are 5.0 trillion. So the budget deficit's $2 trillion, which is a
So,
pretty big
so
number.
back up just real quick, Bob. Sorry to educate me and listeners. Why would the bond market care about a deficit?
So the bond market, the bond market's basically a bond is basically a loan. So if you buy a 10-year treasury bond, you're making a loan to the US for 10 years. So what bond investors care about is really two things. One, just black and white, am I going to get paid back? If I buy a $100,000 treasury bond that matures in 10 years, I better get $100,000 back. So that's one. So the risk of default, the financial stability. And then the second is inflation. If I get paid back, then what's the buying power of $100,000 in 10 years going to be? Will I be able to use it for a down payment on a home, to a meaningful degree, or is inflation going to be out of control and $10,000 is going to be, or $100,000 is not going to be, that meaningful in 10 years. So the bond market cares about inflation and financial stability of the issuer, which go hand in hand.
The US, I would imagine part of why people have been complacent for a very long time is you just can't imagine the first thing not happening. Basically, you're going to get paid back.
You're going to get paid back, yes.
Right. So it's what you're going to get paid back with and what it'll feel like that is more concerning to the bond market.
Yes, what the inflation rate will be between now and then. Inflation and interest rates tend to be correlated. So if borrowers think the issuer is less creditworthy, they demand a higher rate. I mean, that's what a debt spiral is. As rates go up, the interest on the debt goes up, the financial picture gets bleaker. What happens? Rates go up even more, and it's not a healthy cycle.
So,
Just
so sorry. Thank you for that detour. I know I interrupted you, but please get back to where you were.
So just back to the numbers. So we went from in 2015, I said about 3.7 being spent, three and a quarter coming in, so a $450 billion deficit to $2 billion deficit this year in 10 years. So that's a pretty big change. And now with the interest at 21.4% of the debt, so you take that as where we are currently, which is a pretty tough position. And then if you project out, looking at the bill that passed the House, that is expected by the Congressional Budget Office to add, I believe, $3.1 trillion to the debt over the next 10 years. So looking at more debt moving in the wrong direction. That's one point. Second is interest rates have risen. So the Treasury issues fixed rate debt, but as it rolls over and matures, it gets reset at a higher rate. So if you play it out over, say, the next 10 years, not just the amount of debt will be increasing, but the rate on that debt is expected to increase. And that's, I think, the main reason why President Trump is all over Powell and the Fed about lowering rates because he knows how that math works. So you have more debt coming at a higher rate, and that it's an issue because that percent of tax receipts that goes to pay interest on the debt is expected to just increase over time, and that's what the bond market gets concerned about.
And we don't know where the tipping point is.
We don't know where the tipping point is, but it can start to accelerate, like I said, because then as the bond market gets concerned, what happens? It's supply demand. Demand dries up a little bit, so yields go up. And as yields go up, the tipping point accelerates because then that math gets even worse as far as Now the rates are higher. Now the percent of revenue that goes to interest expense is higher. So, being where we are now at 21%, it's already pretty high. So I don't think it's that far out. I think we're around there. That's what Jamie Dimon was alluding to when the other day he said you'll see a crack in the bond market. And even in April, when we were seeing stocks fall, and typically there's a flight to quality, the flight to bonds wasn't as strong as it has been in prior um, periods of crisis where people go to the safe haven being U.S. Treasuries. They didn't quite perform like the safe haven that they have in prior periods like this.
So bring it out of the happy hour conversation that we were having and that you and I are having right now and back to your day job. You're an asset allocator. Are you and your team talking about moving away from US fixed income or treasuries in the short term because of this?
Yeah, so as far as if you view that as a fair concern, how do you allocate around it? What we did entering this year was we increased the allocation to real assets. So we have real asset exposure through real estate and then also through commodities, including precious metals, equities of commodity producing companies, tips, so that there's a mixture of assets that are more inflation sensitive, and we increased that allocation earlier this year. That's point one. Point two would be within fixed income, keeping it on the short to intermediate end. So you can't abandon bonds in a portfolio. They play a role, but what would be at the most risk would be longer term treasuries. So our treasuries have a maturity of about 5.5 years on average, which we're comfortable with. It's longer than T-bills, so you lock in today's yields, but you're not going out too far. So keeping that on the shorter end, and then back to equities, having global diversification within your equities. So a healthy allocation to foreign markets, like where we started. And when I was reading off those numbers earlier, and like foreign developed international equity being up in the double digits, close to half of that return is just from currency moves where the dollar's weakened. So having foreign equities is a big part of diversifying from a risk that's concerning around U.S. debt, the dollar, treasuries.
What about foreign bonds, Bob? Like, how do you think of that category generically, and then maybe in this environment? And I don't know if I saw a mini grimace when I asked you about foreign bonds, if it's a loaded topic on your mind these days. But generally, you don't see them in our portfolios very often and in any meaningful amount. So, how should investors process what you're saying and why the foreign stock market exposure, but not any foreign fixed income exposure?
Yeah, you kind of hit a bullseye there. So I explained what we have done, and what we're working on is foreign bonds. And I don't think I've shared that with you.
I'm
So
just that good, Bob. I'm just that good.
we're looking into foreign bonds. Historically, our view on foreign bonds has been that if you take the currency risk, like say you buy Japanese government bonds, your exposure, the majority of your return is going to come from the difference between the yen and the US dollar, not clipping coupons on Japanese government bonds, which in the low single digits, but you could see 10% plus or minus swings in currency. So it's more of a currency. The bigger risk is currency than your traditional fixed income. So we've intended to keep our fixed income US based, dollar based, to eliminate currency movements, which can be significant. You can invest in US dollar debt issued by foreign companies and countries. So you can eliminate the currency risk and then just get exposure to different yield curves. So if the US yield curve steepens, if it's from a different issuer, you don't see the sell-off that you would. So that's kind of a lighter way of getting diversification. So that's probably the least disruptive way of introducing some foreign exposure to a different bond market, a different yield curve, without taking on the currency risk. Or you can take the currency risk and then hedge it out, but then that comes with a cost. So you have to kind of do the math and see how much are you willing to give up there. But that's something we're looking at. We do get the currency exposure within equities. And you might say, well, if you're not okay with the currency risk in fixed income, why are you okay with it in equities? And the response there is that equity returns are higher. So you have a stronger return in equities, and while the currency movement is still meaningful, it's more balanced with the drivers of equities, which equities on their own can move plus or minus 10%. It's just bonds when you're looking at low single digit yields that the currency movement is much more significant. So we're looking at it, and it may be around the corner. So that's something my team's working on right now.
So when you evaluate fixed income, you look at yield, I think, and credit risk.
Yes.
Are you investing with a manager who would buy a developed international fixed income portfolio, or are you buying German bonds?
It's on the table. I mean, you can even a company like McDonald's will issue foreign debt. They'll
Hmm.
issue
So
McDonald's
corporates.
bonds
Okay.
in Mexican pesos.
Okay.
So you can get a US credit in Mexican pesos, and the credit risk is McDonald's. So that there's a number of ways to do it, and that's what we're doing now is just navigating through the different approaches, whether it's the McDonald's example in Mexico, or buying German bonds as an example, or Japanese government bonds. It really comes down to the three C's. As you said, credit risk, then the country risk, and the currency risk. So which of those three do you want to take on, and are they beneficial? Do they improve a portfolio? Yields in the US have improved now from where they were 10 years ago. So a lot of what we do with investing is looking at things and then just saying, nope, we were good. We don't need this. So that very well could be the conclusion. But it's something we're just looking and seeing if we added a probably reasonably small slice of foreign fixed income to our fixed income allocation, would it improve outcomes based on our expectations?
Are you seeing higher yields?
It more in the emerging markets, you see it where the risk is greater.
Okay.
Developed international, no, typically they have not yielded more, like Germany, Japan. So then it becomes more of a diversification story, and that's a harder pill to swallow. Will you take less yield for less risk? So, and that's where it may turn out to just be kind of lukewarm on it and you'd pass. But at the same time, do you want emerging market debt to juice yields? That comes with more risk. And, we want our fixed income to be strong. And that I may have just jumped to the conclusion. Um, but there are other ways to look at it, and other potential avenues. So it's something we're working on.
Yes, you are. All right. Thank you. I appreciate that. Something else that the news gave us as a topic recently, I forwarded you, I think, a Wall Street Journal article about how endowments, college endowments, the large ones, are changing their investment strategy because they are going to be paying higher taxes, basically.
Yeah.
And I thought that that was interesting because you could translate some of what they were doing or what they were concerned about to individual investors who are tax conscious. So they were talking about being, more liquid so that they could pay tax bills. They were talking about lower turnover strategies so there'd be less capital gains. I think you point out in our conversation maybe they could be looking more at municipal bonds instead of taxable bonds. So what jumped out at you when you saw that?
Yeah, it's interesting. The article was timely, and a colleague of mine, Michael Waldron, went to a CFA Boston Society meeting where they had a roundtable of regional endowment CIOs talking about that change, and how it could impact the investment environment. And the number one thing that jumps out at me is municipal bonds. So municipal bonds are a strange market because the participants are basically limited to high income US retail investors. So individuals who pay ordinary income taxes are typically in a high tax bracket, are the ones who buy municipal bonds. If you take any other financial asset in the US, namely like treasury bonds or stocks, the participants for those instruments it's global. It's not just US, citizens, but it could be that the South Korean sovereign wealth fund would buy US stocks and treasuries. And so not just at the country level, but then at the individual level, it's open the stocks and treasuries to basically anyone. But munis are limited to individuals in the US. And that leads to some erratic behavior in the muni market. It's not the most efficient market, I would argue. You see like periods in April where there's less liquidity and munis will sell off a lot, probably more than they should, because it's just that the buyer pool is not that deep. And endowments being taxed in the US basically introduces them to the muni market. Now, if they're paying 21%, they're kind of break even. They'd be the marginal buyer at 21%. So all else equal, if you have a muni and a treasury and it's a double A or triple A rated muni and a treasury, they would take about a 21% lower yield, not absolute, like relative, like yield to invest in munis for the tax exemption. So by bringing institutions in, it should bring a little more stability, make that market a little more efficient. You have a more sophisticated buyer, which is a bit of a game changer to the muni market, which it should provide more of a floor, so you wouldn't see those big swings, less opportunities for investors who like to buy munis when they get really cheap. But that to me was the biggest takeaway.
Great. I appreciate that overview. I think it was interesting. We have private investments in our portfolio. We have investments that are somewhat illiquid, not fully illiquid like private investments, and we have to size them at an appropriate level because, clients have cash flows. So seeing that they're still attracted to those asset classes, but they want to lighten up so that they have more liquidity annually or quarterly to pay taxes was interesting. And to me, fed into a little bit of how we manage money for high net worth clients. And then, on the low turnover equity strategies, we prefer those to be in our taxable accounts. And if they're higher turnover, we prefer them to be in tax deferred retirement accounts. And now that their tax bills are going up, they're looking at that level in their portfolios as well.
That's right.
All right. Anything else on your mind? I mean, I guess I pulled forward your next project. I got it out of you. I had no idea. So you're going to have to find something else to work on in the next couple months. But anything else on your team's mind?
I'm just looking at my notes. Sometimes I make notes for this podcast. Since we went over the debt and deficit, one thing I think people have a hard time understanding a trillion as a number. So just some fun facts. If you compare million, billion, and trillion, so 1 million seconds ago is about 11 and a half days, less than 2 weeks. A billion seconds ago takes you back to September 1993. Was looking for something interesting that happened in 93. Didn't really find any good music or movies. Drew Bledsoe was quarterback of the Patriots. I mean, it's not that long ago, right? Trillion seconds ago. It's 32,000 years ago. 30 BC. 30,000 BC. So
Wow.
it just the magnitude of a trillion, how it gets thrown around these days, and then just a different way of looking at it. If you take out $100 bills and you just kind of paper a line of linked $100 bills, $1 million is about 1 mile of just $100 bills in a row. So then $1 billion is 1,000 miles. So you go from here to Florida basically with $100 bills, and that's $1 billion. To get a trillion, you wrap $100 bills around the world 39 times. And the
All
budget
right.
deficit this year's 2 trillion.
Yeah. I'm not
So
gonna lie, I was worried that wasn't going to be a fun fact, but it was actually pretty cool. So thank you for doing that and providing that context. So you're basically going to be watching the bond market with your team, and you're going to be watching this legislation as it goes through, and you're going to be making some decisions as to where to be on the yield curve to protect client portfolios from rising rates or further inflationary concerns, in addition to having the real asset exposure in the portfolio and thinking some other areas to invest.
well said.
All right. Thanks, Bob. I appreciate your time.
All right, thanks, Sammy.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakamis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.